Gopal Balachandran, CFO and Chief Risk Officer with ICICI Lombard joins us. Now, Gopal, good morning. Thank you for joining us. Growth in your focus area, retail healthcare, has been fairly strong in Q1. Is this growth sustainable?
That's a great start. So if you ask us, health definitely is one of the areas of preferred segments of opportunities for growth for ICICI Lombard. And exactly as you mentioned, I think we have had industry-beating numbers in the context of growth, particularly when you look at for that particular segment. And for us, when I said it's a preferred segment, it is both the employer-employee or let's say the corporate health equally as an area of focus. And the other segment that you referred to in terms of retail health is also an area of opportunity where we have been investing a lot. Now, again, in the context of retail health, when you look at for ICICI Lombard, even this quarter, we have actually kind of grown faster than the industry. Last year, again, when you look at the numbers, industry grew at roughly about 15-16%. ICICI Lombard grew at about 17%. If you look at quarter one, our retail health numbers grew at almost about 23%. Industry growth was about 18%. And that's a segment that we are very excited with and quite happy with the way how growth have played out. And even on the corporate health, again, if you look at, I think we have again had industry beating numbers. Industry grew at, we have kind of almost doubled the growth numbers when you look at it in the context of growth for ICICI Lombard. So hence, quite excited with the way how the investments in the retail health franchise is playing out. And that's an area which will be a continuing one in terms of continuing investments. In the past, we had a market share on that particular segment, which was less than 3%. We have been able to kind of make an improvement thereon. Currently, as we speak, the market share stands improved to 3.1%. But as I said, this will be an area of continued focus, both in the context of retail health and corporate health.
Okay. So Balachandran, if I can just push you a little bit more on the mix, what is the outlook when it comes to health? Is it as big as motor for you? What do you think is going to be the trend?
Sure. I think again, as we keep saying, for us, if you ask us, all the three key lines of businesses are areas of focus. When I say all the three key lines, whether it is motor, whether it's health, or whether it is a commercial lines, all of them are clearly areas of opportunities is the way that we see for ICICI Lombard. And hence, we obviously would like to see growth momentum sustaining across the three key lines. Having said that, you are absolutely right. Historically, motor, by the way, has been the largest contributor to the overall revenues. It's been for understandable reasons during COVID periods for 2 years, clearly health displaced motor as the largest contributing segment. And as we speak, health continues to be one of the fastest growing growth segment. So hence, to that extent, even for us, when you look at it from a growth percentage standpoint, health would have kind of grown relatively faster as compared to, let's say, some of the other lines of businesses. So hence, in terms of mix, we clearly believe that health will continue to grow disproportionately faster. Motor in the past for us has been a conscious call of going a bit slow, given the reasons, significant aggression that the market has been exhibiting. Already we are again seeing in motor specifically signs of growth emerging back to us. And commercial lines, again, historically, we have always kind of disproportionately grown relative to the market performance. Hence, to answer your point in terms of mix, health in terms of growth percentages will continue to grow faster. But in terms of the overall mix, my sense is it will be broadly almost a kind of an equal split between commercial lines, motor, health, and a very small proportion of our portfolio will also comprise of crop.
Right. And with regards to your loss ratios, your motor OD loss ratio has now significantly declined to about 67%. What's causing this?
For us, claim service is definitely an area of priority. And we kind of put a lot of focus, emphasis in terms of making sure that the experience for the customer is significantly superior. Since you talked in the context of motor, I think what we have been able to significantly drive is, today when you look at when an accident happens, many a times it so happens that the insurance company is possibly last in the pyramid to get to know of the claim that has happened. That's a direction that we are planning to change, by which we are significantly looking at diverting traffic to what we call as a preferred provider network, whereby we are able to be the first notice of loss as and when an accident happens. And to the customer, we are able to make sure that the experience of repair is extremely seamless. And we are able to divert that particular claim incidence to a preferred network of garage, where both quality of repair is quite superior and even the average cost of claim that the customer is required to get exhibited to is lower. And so there again, when you look at the PPN numbers, which typically we track in the context of non-OEM claims, the proportion of claims that we were able to divert to a preferred network of garages, that number was about 40% last year. This year, the number is upwards of 65%. So this, as I said, clearly helps both in terms of the quality of repair. Otherwise, you would possibly end up in a situation of coming back again to get your vehicle repaired, and which could possibly increase the cost of claims. And two, as I said, given that we have been able to divert it to a preferred network of garages that we kind of vouch for, the relative average claim sizes are also equally lower. So both of this have significantly kind of aided in terms of trying to keep the overall claims under check. Definitely quarter one may not be the only way to look at. Ideal thing is to look at more over annual cycles, but more importantly over periods of 3 to 5 years.
Right. So the other piece is loss ratio on the health, and that has seen a sharp rise. So fully appreciate that it has gone from 73 to 78. But can we look at that number quarter wise? But what is the larger target or a band where you see loss ratios for motor as well as health?
So honestly, I think what we have spoken about to the market is from a combined ratio perspective, which has got both the loss ratio and the expense ratio element put together. If you look at FY23, we exited roughly at about 104.5% combined, the overall numbers. And to the streets, we had said over the next couple of years, which is by end of FY25, is when we had said we will get down to a trajectory of combined at about 102%. So that's the direction that we want to take. And the effect of this change will be a combination of improvements in loss ratios and equally some of the investments, as we spoke just a little earlier, all of them will fructify in the form of improved efficiency in operations, or let's say improved productivity. Now, both of them is what is going to aid in terms of the improvement in combined. So therefore, directionally, that's the path that we want to take to bring down the combined to about 102% by end of FY25. Having said that, I think particularly in the context of the health loss ratios that you kind of spoke about, again, these are quarter one numbers. As we keep saying, if you look at more on an year-on-year basis, let's say on a full year basis, and even if I were to split this number of 78.7% that you referred to for quarter one this year, if you look at the corporate health loss ratios, that number was roughly at about 92%. And retail health within that was about 65. Now, this is quarter one. But if you look at it on a full year basis, my corporate health was actually at about 95. My retail was broadly in that same range of about 64, 65. So that range is something that we are quite comfortable with, whether you look at both the segments. Generally, we have talked about the corporate health loss ratio staying in the range of 94, 95%. And retail health, we have generally kind of talked about in that range of 65 to 70 is the range that we are quite comfortable with. But as I said, ideally, we would want to look at it more in the combined ratio trajectory of getting down to 102 by FY25.
Right, and you did speak about OPEX in the motor space. So how should one look at the overall OPEX in FY24 versus 23? Because you did say, as per expenses of the management guidelines, you are within the limit. Talk to us about how efficiencies will play out.
Again, that's a great question, because for us, as we keep saying, there are 3-4 key areas that we significantly stay focused on. One is obviously to kind of increase distribution, because that will kind of significantly aid growth. And two, for us, we continue to stay invested in investments in technology and claim service. Now, let me give you a simple data point, because again, we keep looking at sustainable growth over longer horizons and not confined to, let's say, shorter periods. If you look at for ICICI Lombard at the peak in terms of headcount, this is way back in 2008, we had a headcount of almost about 18,000 plus. Today, my headcount number is down to less than about 14,000. This is after the acquisition of Bharti AXA that we did almost about a couple of years back. So we have had almost close to about 30%, roughly about 25-30% reduction in headcount as we speak. But having said that, if you look at the volume of policies that we write as a company, again for that same period, 2008, we used to write about 3.5 million policies. I mean, last year, FY23, we exited by almost about 32 million policies. So that's been a 9x increase in policy count, whereas we have had, let's say, close to 25% decline in headcount over a 15-year cycle, which roughly translates into an headcount productivity of almost about 15% over a 15-year cycle. So that's the way we kind of look at it. But to get more specific in terms of how we would see expense ratios play out. Again, when you looked at, let's say for quarter one, as I said, the breakdown of the combined is the loss ratio and the expense ratio. The expense ratio for quarter one was roughly at about 29.7. This number was lower than when you look at quarter four of last year, which was at 29.9. And even if you look at it on a year-on-year basis, let's say quarter one of last year, the expense ratios as a element of combined, that number was almost about 32%. So directionally, I think we have been able to kind of significantly bring down the overall expense of management. And as you rightly said, for ICICI Lombard, we have always been within the threshold that the regulator has laid down. And as I mentioned, 2/3 of the market participants are operating at thresholds which are much higher than the regulatory stipulation. So directionally, once that starts to see an improvement, that by itself presents increased opportunities of growth for ICICI.
Right, and therefore, how is it that we should be looking at your combined ratio for the full fiscal?
So as I said, I think we have talked, as I mentioned, we have spoken to the market over the next couple of years to get the combined down to 102. So directionally, and we, as I said, FY23 we exited at 104.5. So that's a trajectory that we would want to take. Honestly, there are a lot of moving parts within that. We don't want to specifically give a number out for FY24. As I said, by end of FY25, we would want to get to that 102% number.
Now, we've seen cyclones impacting your numbers. Could this possibly be the year of El Nino? There are floods in North India. What happens to the claims because of that?
So honestly, again, that's a great question because, I mean, unfortunately, these days, because of climate change, there has been far more increasing number of events that we get to see on a year-on-year basis. But having said that, whenever this event happens for that quarter, you will obviously see the loss ratios getting impacted. Which is exactly, for example, when you would have seen, let's say, this Q1 numbers for this year, we had the cyclone Biparjoy, which had a net claim impact for us of almost about 35 crores. Now that obviously impacted when you would have looked at, let's say, our loss ratios of fire and engineering, it clearly had an impact. But your point on what can possibly change in the context of the combined ratio trajectory that I spoke about, honestly, we do price in for some of these events in terms of cyclones, flood losses, some of the individual peak losses, etc., etc. But having said that, if the magnitude of events becomes quite severe and frequent, then obviously some of those estimations is something that we'll have to recalibrate. But having said that, the good part is, I think ours is a business which is relatively of an annual nature. And therefore, if at all for some reason the experiences turns out to be an adverse, we always have the opportunity to go back and possibly look at pricing the risk appropriately. And the impact will be something that will be not specific to ICICI Lombard, it will be for the industry at large. And therefore, companies which have been relatively better for us, for example, if you look at ICICI Lombard's combined has been better than the industry combined by almost about 15 percentage points historically, between 10 to 15%. So therefore, we relatively have an advantage whenever these events are far more frequent and far more severe. Early signs, as of now, nothing concerning is the way we would look at, but honestly, too early for us to really say whether these claims could see an increase or not.
Okay, thank you for joining in and sharing with us the outlook. That's the management of ICICI Lombard talking about how there is a bit of slowdown in growth for motor, but they are looking at investing a lot in retail, and health as well has not as of now displaced motor as the largest contributor to revenues. 1334, that's where the stock is currently at.